Welcome to the Small Dog Trading Podcast. For our very first podcast, I'm going to interview my co-founder of Calcinomics and my real-life brother, Andrew Courtney. He's had a career that bridges the gap between floor trading, upstairs electronic trading, and the start of AI in the markets. Welcome to the podcast, Andrew. So, Andrew, why are we calling it the Small Dog Trading Podcast?
I think to differentiate us from, we're neither of us are currently institutional traders. My background's in professional trading, but we're independently building projects. We're independently trading. We're small dog traders and proud of it. We don't take ourselves too seriously, but we do want to talk seriously about trading and decision making and how these especially prediction markets work.
Love it. So, for listeners who don't know your background, Andrew's first exposure to being a trader was an intern floor runner on the CBOT in 2007. He got to see the organized chaos of floor trading up close. And after starting full time, he went through SIG's famous education program and then focused on international equity ETFs for years, along with a brief stint in options market making. As a hobby, he joined the Good Judgment Project, which is a forecasting competition, and was designated among the top performers that were determined to be super forecasters as the top participants in the study. And then after leaving SIG in 2023, these days he calls himself a house dad, but the growth in prediction markets have pulled him back into following everything that's going on in this space. He writes his Substack called the Whirly Gig Bear, helped develop a data visualization app called Calcinomics, and trades casually in prediction markets.
Thanks, Aaron.
Yeah. So let's talk a little bit about kind of your college decision making. I know you kind of started off in the engineering track, computer science. How did you decide on that? And then how did things shift towards the finance world?
Yeah, so I started in high school. I got a scholarship from the company Kodak in Rochester, New York. Kodak was one of the major employers. I went to Cornell, which is a fairly expensive school. Scholarship meant a lot to me in terms of paying for college. And part of the stipulation on the scholarship was I had to pick an engineering major at one of a list of like 5 they gave me that was important to Kodak. And so I thought circuits were cool and I liked math. So picked electrical and computer engineering. And that's about all the thought I had put into picking a major at that time. I said, why not give this a shot?
Got it. Well, yeah, at that age, it's funny how little things kind of drag you to various degrees. I liked looking at stocks and wanted to potentially be in the finance world before pivoting more into the math economics. So, yeah, I guess did you end up doing work for Kodak or how did you end up thinking more about the finance world and trading?
Yeah. So part of the scholarship was I was supposed to go to Kodak for a summer internship. But I think you can look at the stock price for Kodak. I didn't think they were aggressively hiring at the time. And so they said, oh, Andrew, you don't have to do that. The other thing is I went through my electrical engineering classes. I was doing fine, but noticed some of my classmates that wanted to stay in the computer lab all night on Friday nights, were spending their weekends building robots. And I was more interested in reading The Economist and getting really good at Guitar Hero. So it came down to, I don't want to compete with people that really enjoy doing this. I want to find something that calls me a little bit more. So started thinking a little bit more about finance economics. One of the big decision points, I did a summer internship at a defense contractor. And as part of that, I got to sit down one-on-one with a senior executive and talk about what progression might look like at that firm. And there's a pretty rigid track of you spend this many years in this role, you get a promotion, a small pay increase. If you do really well, maybe you get a year ahead. And I asked him, okay, let's say I want to work really hard when I'm young. How can I get through this a little faster? And he was like, Andrew, maybe you should consider finance instead. And so that was kind of I was like, okay, maybe I should. I wanted something that had high leverage to my own effort. And it sounded like there was more of an opportunity on finance or Wall Street to do that. So for the next year, I started transitioning my electives to more economics, started going to info sessions. At the time, this was like Bear Stearns and Lehman. And so, started going to investment banking and sales and trading. And I had no idea what either of those were, but I knew that these were the best put together info sessions on campus that all the motivated kids wanted to go to. Eventually figured out that it was probably not investment banking for me. And so I looked more into trading and eventually found there's these quant firms that had a little bit of a different culture than mainstream Wall Street and thought that might be the best fit for me.
Got it. So you talked a little bit about competition. We're a risk related podcast, so I want to ask, like, when you're looking at more of I don't know, a traditional engineering path or like a lot of other kind of corporate paths, it's like your upside and downside, I think, is limited to a greater degree. I know in my career path, especially at insurance companies, if you outperformed your peers by 2x or something like that, you might get a 1% greater raise or a 1% less raise, and you're not necessarily going to get promoted or fired to that degree. So, do you see the asymmetric risk on the upside and downside when making that kind of choice, and do you like that?
Yeah, I remember talking to someone at a company, and one of the pros of the job, and in their opinion, was they said nobody ever gets fired here. And is if you're in and doing like nobody gets fired, it's great. And to me, that's not the type of place I want to work in. I want to work in a place where you have to justify your position, your role, and you're also taking risks to the upside. So I don't think you can get upside opportunity without also taking some risk. But I was young. I had this engineering degree I could fall back on to go into a path that was maybe more stable if this didn't work out. I had no idea if it was going to work out, but I wanted to take that risk when I was young, and I thought this was the best place to do it.
Yeah, and certainly at a young age of all times is like, when you should be making those asymmetric risks, at least in my opinion, because the downside is much lower when you can switch career paths, whereas you're not going to get exposure to that upside unless you do kind of put yourself out there to some degree. So I guess let's do a little detour. We kind of talked about your education background, but tell me about the Good Judgment Project. Like what exactly is this? How did you get involved? Maybe any interesting stories that happened during your experience working with that as well.
Yeah, so I think this was around 2013, 2014, and there was a study you could sign up for. It was run through, I believe it was IARPA, and several professors from the University of Pennsylvania. And it was basically a prediction market. You signed up, you got to trade on all these markets, and they're mostly geopolitical or financial events. So there were some, it was, forecasting the price of the euro, or what is the chance of a war between these countries, or is a snap election going to be called in this country? And it turned out at the time I was trading international ETFs, and a lot of the geopolitical things are things I already thought about every day at work in terms of what are the risks of these different markets. And so it was a bit of a natural transition to think about these questions, which were often a little bit different than the risk you'd have in financial markets. Some of the most interesting ones were those that had no financial parallel. So the stability of some regime in Africa, and there's no stock market, there's no derivative or anything, there's no price you can look at. And so you start researching, like, what are the local media outlets? What's the history of this country? What's the history of the region? And whenever I get to dive deep into those things and learn a lot, that's something I really enjoy. And so throughout my career, finding opportunities to be curious and learn and also hopefully make money doing it, that's one of the most motivating things to me.
Very interesting. So there was no financial ties to one being a part of this or when it comes to the actual like forecasting or trading. Is that right?
I think I might have gotten a gift card, maybe $100 or something from Amazon for, 100 hours of work. But no, it was a volunteer project.
Got it. So I guess in relation to, a lot of the prediction markets we see today, some people say that because there's money at stake, that's part of the reason that these sometimes can be more accurate in forecasting than traditional polls. So, your major prediction markets right now are Kelshi and Poly market for the bulk, but there are other kind of play money markets like manifold markets among a million other like variations. Just curious, do you think having money at stake does make things more accurate, or is it more about the people involved, or any other takes in that regard?
I definitely think having money at stake is going to make for more efficient markets. However, as places like Manifold and the Good Judgment Project show, there's at least some of us that will do this for fun. And it's not everybody. It's a probably a small subset of individuals that want to research this stuff, but it shows you can do okay finding motivated individuals that do this either for a very small amount of money or for nothing. That said, I think the financial rewards can bring in a much broader set of individuals because some people need to make money from trading rather than doing it as a hobby. And you can also get a lot more people's time by providing incentives. So I think the real money markets are going to be more efficient, but I don't think they need to be billion-dollar markets to be efficient. I think more liquidity is better, but we don't need everyone in the country to be trading elections. We need a small motivated subset of people that are thinking hard of this. And I think you get most of the value from that.
Interesting. So this is like, I guess, a little bit of a curveball, but like more from like a political decision making. A lot of people believe that decisions should be made democratically. Like every person should have a say in like major decisions. Would you like prefer if like maybe a sub segment of people were voting for a specific decision, whether, scientific or something else, or any thoughts there?
Man, that is a curveball. Well, I mean, this country, for the most part, we elect representatives to make decisions for us and then judge them in the next election by what decisions they made. So there's already some amount of indirect. And like some places have more of a direct democracy for certain decisions. I do question whether the average person has the information they need to evaluate a municipal finance project, for example. I think in Philadelphia, I was asked to vote on some bond offering. And I'm probably one of the most knowledgeable general financial people in Philadelphia, but I knew nothing about this. I know nothing about municipal finance. I just said, okay, well, what does the local political party recommend? I entered that. I'm adding no value, adding no signal to that question. So not every decision needs to be every citizen adding. And in trading, if you have participants that don't actually have real information, we call those noise traders. And so if all we add to a decision is more noise, that doesn't help the decision. Not every question needs to be a vote.
Got it. So let's kind of move back to SIG and in your career there. I guess first off, would you say that SIG, what do they profit off of? So you talk about like these noise traders, like would they be extracting value from something like that? Or is that too simplistic of an approach?
So as a market maker, you're trying to find fair value of a product and quote around that. And if something you think is worth $10 and you can buy it for $9.99 and sell it 10.01 and do that repeatedly, you're going to make money. And so if the trading is all just random, you're going to make half that spread on every trade. As we know, there are people that really do have information. It could be news about a stock. It could just be information that they're about to buy a lot of that stock. And so as a market maker, sometimes you get run over or adversely selected against by people with more information than you. So it's about balancing, providing liquidity at the right price to both informed and uninformed orders, but avoiding too much adverse selection or adjusting how much risk you're willing to take and how wide your spread is based on the chance of adverse selection.
Got it. And I think there's probably a lot of similarities there from like a information asymmetry perspective when we do talk more about the prediction market landscape. But to dig into SIG a little bit more, so I know they're famous to some degree for how they train their traders and even for like the folks that they're looking for. So I know they have like some type of poker training program. You guys are also, often really into strategy games and just making plus EV decisions. So yeah, do you mind, telling me a little bit about what that training encompasses? Maybe anything else interesting that comes along with that interest in strategy.
Yeah, so I think part of the reason I got the job was a combination of the math background and engineering, and I was also a poker player. And it's funny, in college, I thought I was good at poker, but one of the things I realized early on at SIG was that I was not actually that good and had a lot of mental biases. So this class, during your first year and a half at SIG, you'd be helping out on the desk as an assistant and then have trading simulations, academic lectures about finance, math, options theory, and also quite a few lectures on decision biases and how we can fool ourselves or how to make better decisions, and a whole lot of exercises. And it's really hard to correct your biases. It's not something that you read thinking fast and slow and all of a sudden you fix all these things. You may be aware of things that you're not doing correctly, but it's really hard to actually change your habits. I'll give you some examples from my online poker days, and this is embarrassing, but this is before, I went to say I'd be at a poker table and I'd lose a big hand to someone. I'd I'd look at those chips and I think those are my chips. I want to get them back, and I'd play differently based on had I just lost or had I won. Is this like house money or am I down and need to get back to flat? So thinking about like my recent profit and loss versus my overall bankroll. Looking back on this stuff, I'm like, how? But I think a lot of people have those biases. Another one was I would study a bunch of poker theory and I would want to move up in stakes. And I think, okay, I want to beat like one of the regulars at heads up, no limit. And I guess maybe improving yourself, you're a good poker player, that might be useful, but in terms of actually making money, which was my real goal, you don't want to play the best players. You want to really focus on selecting the right games. And so part of learning, going through psych education, okay, how do I find the right games? What are games I don't want to play in? Or for a market maker, where am I likely to encounter a lot of adverse selection versus where am I less likely to, and when can I take more risk? So it took a while to fix these things in my head. I think the first year, just working with other people that were all trying to do this too really helped. But looking back on it, I'm a little embarrassed that my thinking process is related to gambling type games.
Yeah, that's a honest take, and I think a lot of people can relate to that. Tilt is a real thing in poker and gambling, and there's this fallacy of like getting back to where you were, and that's such an anchor that a lot of people have when they are gambling, or even if they are plus EV bettors, they can get caught in that trap. Also, just to say with the table selection thing, it's like you always want to know who your competitors are, or who your counterparty is when you're trading, right? So there's like a saying of like, it doesn't matter if you're the 10th best poker player in the world, if you're playing with the top nine other poker players in the world, you're going to be the fish at the table. Whereas you could be the 100th in the world, but still be like very profitable. So it is really about finding the right place for where you're playing or where you're trading.
There's a good quote in financial markets. I think it was a guy on X, goes by Robot James, and in terms of trading, it was talking about if you're not worried about the liquidity of the market you're trading, you're probably in the wrong market. And so this means is if your trading is so much smaller than liquidity on, say, S&P futures, you probably don't have an edge. The higher liquidity in general, the more efficient and the tougher to beat the market. And so when thinking about which market should I look at, it really depends on your skill level, but also your bankroll in terms of finding the right level for you. The right place to start out is not in the most efficient markets. It's in the least efficient markets that might be tough to trade, not have as much coverage. And right now, I think prediction markets are one of those places in certain spots.
Absolutely. Yeah. So before we get in more into the prediction markets, I guess, is there anything else in your career at SIG? I know you were, kind of famously trading a ton of international ETFs, but any other like experiences or like interesting stories that you may want to share?
One thing I think that's a little unique is there was a focus on the team rather than the individual, which a lot of people think of trading as this really individual, merit-based sport, which it is to some extent. It's very competitive. But one of the philosophies that we had that I really took to heart was that a group of people that are constantly debating decisions, constantly criticizing people constructively is going to lead to a lot more growth and a lot better traders than a bunch of mercenaries trading solo. And so a lot of the environment for me was even when I led a team, people constantly questioning me saying, Andrew, I disagree with that decision. Here's why, publicly in front of everybody else. And I would say, okay, well, here's one reason I like it. And, we'd argue back and forth. And Yeah, I was wrong a lot of the time, and other people say, that's a better idea. Let's not use my idea. Let's use yours. Or sometimes, we fought it out, and I did have the right idea. But that type of process and being open to criticism and feedback, I think, was a pretty unusual part of that environment, and made me a lot better than I would have been as a solo trader.
Yeah, I think that's a really good point when it comes to all types of trading and plus EV gambling, et cetera. So many people do try to do this siloed, and I think a lot there are, the select few that have been successful in that. But I think that, whether it's your small group of people or, I've even had some probably not as intelligent takes on like X, but sometimes just by like putting my own theses like out there, it's like you get the community feedback, and by putting yourself out there, you do learn more. So I think it's important to gather up other people's feedback, be not be too critical about feedback in the first place. But I'll also caveat you don't want to give away your winning strategies. You don't want to publicize those necessarily.
Absolutely. And also, if the people you're talking to don't actually have good opinions on the market or whatever, or aren't thinking critically, then there's not any value in talking to them. So pick the right group of people. There's a lot of information online, and it is very mixed in terms of quality. So be rigorous about deciding who you talk to and who you learn from.
Absolutely. All right. Let's seg into prediction markets. So we talked a little bit about the Good Judgment Project, but you've kind of been getting more interested in this space. We worked on a project together. So tell me about your kind of newfound interests in the prediction market landscape, and maybe why you think it's important, and like any other personal interests there.
So right now, Kalshi and Polymarket are getting a lot of press. But as we talked about with the Good Judgment Project, and there have been other exchanges for political betting for a long time that have, been more or less legal, depending on what was going on regulation wise. I think right now is a unique time where regulatory environments opened up, that these are more accepted and growing. But it's important to note that they didn't invent prediction markets. The concept has been around for a really long time, and this is maybe the first, rapid growth and wide stream acceptance, but that it's not a new concept. And, political betting, sports betting in various contexts has been around for a very long time. When I think about what is the most useful, or what are the most useful applications of prediction markets, you have to point out that something around 90% of the volume is sports betting, which is fine.
Hmm.
I think it's good to have a exchange model versus a house model is what I prefer, and opening up access to more people, and hopefully more competition will bring in uh, tighter spreads to the market. But is that really important to us as a society to have slightly more efficient sports prices? To me, not really. I think having official or efficient political and economic markets is great. I think having markets on elections is fantastic. Being able to see the impact of news on, say, a candidate, or recently in geopolitical events, when Trump talks about Greenland, you can look at the various Kalshi and Poly market, will the US acquire Greenland, and get a sense of how important that statement was, how educated observers are interpreting what just happened. And so I do this when I read the news, is read an article, check the prediction market. Did it move? And when did the article come out? Did it seem like it had some price impact? And this helps you get a context for, is the stuff I'm reading in the media, was it surprising to the world? Or is it just a statement of what's going on? Is the market fading this? Or if the market moves in the opposite direction, what am I missing? And so I've made this part of my daily news process when I read about current events, is if there's a prediction market, I check back and forth and see, oh, does this make sense to me? I think it gives a lot of great context to news.
Yeah, I absolutely agree there, and I think that particularly like with the current administration, I'm always keen to see what sometimes the president says versus what's actually being shown in the charts. Towards the end of last year, he said that millions of dollars have been received for gold cards. And then I checked the market on Kalshi, and it was trading at 95% for 0 gold cards to be sold. Is that more realistic lens versus what people are saying? And then two, that kind of the traditional mainstream media kind of has this bias and almost incentive to be sensational And they also use these vague terms like this is probably going to happen, this is definitely going to happen. Like, what does that mean? So, yeah, I love that take. Let's see. Both of us, we kind of co-founded and worked on this like data visualization analytics site called Kelshinomics, which I think we can get into, maybe on a future episode. But you've also, had a ton of people start to follow your Substack, and I've really enjoyed your writing from a prediction market lens, in addition to some of the other topics that you cover. So everyone's called the Whirly Gig Bear. Just want to ask why the Whirly Gig Bear?
To be a little whimsical rather than something that involved Bayes' theorem. There's plenty of that out there. I like bears. I have two little kids that love bears. When I was at SIG, there were people who did pools for March Madness or whatever sporting event. And I would run a pool for Fat Bear Week, which is when the bears are eating all the salmon in Alaska, and they would vote like one bear the winner, and they'd have a bracket style thing. And so I would set up a pool on the desk, collect some money. The winner would get a ton of smoked salmon, and then I'd bring in a giant platter of bagels and lox for the desk. And so that was kind of my annual event. So it was it's kind of a random name, a little whimsical. Don't want to take yourself too seriously, and hopefully memorable for people, but it doesn't mean anything.
All right. Well, one of these days we'll have to dig a little bit more into some of your articles because I think it's very noteworthy just in the current landscape that we're in. Like I think you had one, don't just put the chart on the screen or something like that, which was in regards to kind of using these prediction markets directly as a news signal. I don't know, maybe actually just quickly cover like what are some of like the upsides and downsides from like the news angle of including prediction market data.
I think these markets are very useful for contextualizing news, but that doesn't mean they're always efficient. And I mean, the fact that we both trade them and try and make money trading on the political, geopolitical, economics side of things, the fact that I can do a little research and potentially make money implies these aren't the most efficient markets in the world. They are growing, and I'm sure the participant mix is going to change over time. The more informed participants in a market, you'd expect the more efficient price to be. But there's a long tail of markets. There's some prediction markets that have a ton of volume, a ton of activity, and there's a really long tail of really illiquid small markets with just a couple $1,000s of volume. And some of these markets, Polymarket had, I think it was, will the US invade Colombia this year? And it had a really small amount of volume, more like a penny stock than a major index. And so when a news organization puts these markets up on the screen, we need to give the public more than just here's the price to understand how efficient that market is. And I'm not a journalist. I'm not an expert on editorial standards, but having information about the volume, the open interest, the liquidity, again, helps the reader contextualize how important this is, and not presenting that information doesn't give enough to the reader to really understand what this market is saying.
Yeah, and I think that when I was talking about like the downside is the sensationalism of the mainstream media, it's like let's not use these prediction markets to just do the same thing, right? They're a more data probabilistic view, but let's show the detail behind that.
Right. The current price in the prediction market is not the truth. It's the current market price of a contract traded by some participants. It's not the answer. It's just the price in the market. The price in the market is just where the buys and sells are meeting right now. It turns out that sometimes this is a good predictor, but it's not making a claim to be the truth. It's just a number.
Done. All right, man. Let's see. What's next for you moving forward?
I've been really enjoying the writing. It's such a different challenge than trading, and it's led to a lot of interesting conversations with people that I wouldn't otherwise get to talk to. So I'd like to continue working on that and becoming a better writer. On the business side, with these exchanges blowing up, valued over 10 billion for Kalshi and Polymarket, I think there's going to be a lot of new tools around the ecosystem, and that are probably going to be great businesses. So I've been watching the ecosystem, whether it's tools around data, news, alternate trading platforms. There's going to be a lot of opportunity. And so I'm trying to follow everything that's going on. And, Aaron, maybe we'll end up building more products or investing in them or partnering with the team. It's changing so fast. It's a really exciting time. And I also want to be a part of making the ecosystem better for things that I care about. So That's building more markets that I think provide information to the public, political, economic, insurance type markets. The platforms talk about how you could use these markets for hedging. Clearly, that's not a majority of the volume is actual risk transfer, but I do think that's a big opportunity. I think providing alternate methods of either hedging hurricane risk, or I live in Pennsylvania. I would love to insure some Florida hurricane risk if I could do that efficiently and low cost. There are things like cat bonds issued against natural disaster type events, but they're not easy for retail investors to access. And so if there was an efficient platform to transfer more of this risk, I think that would be an opportunity. So I I have specific things that I care about that I think are both publicly useful and could be profitable. And that's the type of thing I want to spend my time on.
Excellent. Well, I think we have a lot of interesting topics to move forward on, but appreciate you being the guest on the first episode. So yeah, that's a wrap. The first episode of Small Dog Trading. Thanks again, Andrew. We'll chat soon.
Thanks, Aaron. See ya.
See ya.